emerging markets are trading at around 13, 14 times earnings, and roughly a 60% discount to the US. That's quite a big gap that you see there. It's about as wide as we've ever seen.
Many Aussie clients, they'll think that they've got EM coverage because they hold the MSCI World ETF or some global active fund. But why does that actually leave them with actual short when it comes to true EM exposure?
If you want genuine diversification and exposure to parts of the world that are unloved and under-owned, emerging markets deserve a seat at the table.
What practical steps would you suggest that an advisor can take, both in terms of how they can think about reconstructing portfolios, but also having those conversations with clients?
The valuation gap between emerging markets and developed markets is at historic levels. Is now the time to increase your emerging market exposure? That is the question that we are unpacking today. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into large outcomes. My name is Bryce, and along with my co-host Ren, today we're speaking to Vern du Preez, investment specialist at Orbis Investments, about the opportunities and the case for emerging markets and how they are picking winners. Ren, good to be with you.
Bryce, good to be with you. It is an exciting part of the world, emerging markets. More than half the world's population. I mean, China and India really carry a lot of weight there. But, some of the fastest growing economies are in the emerging market space. And I think one thing that has really taken us by surprise as we've learned more and more about emerging markets is the breadth of economies. Countries like Taiwan and South Korea, which are quite developed, still sit in the emerging markets bucket. So it's this fascinating part of the market. A lot of great companies, just from those two countries that I mentioned before, you've got the likes of TSMC and Samsung as like leading cutting edge players in their field. And yet too many Australian investors are underweight emerging markets.
Yes, that's right, Ren, and that is what we're going to be covering today with Vern from Orbis Investments. And a huge thank you goes to Orbis for sponsoring Basis Points.
That's right. For over 30 years, Orbis have been focused on finding global stocks that are undervalued or overlooked by the market. Their approach is all about the long term, looking beyond short-term performance to identify companies with real potential.
With a team of 60-plus investment professionals worldwide, Orbis sticks to a contrarian investment strategy. Managing over 60 billion Australian dollars in assets, their focus on value can offer a great way to add diversification to clients' portfolios, especially in today's ever-changing market.
Thanks to Orbis Investments for sponsoring this episode of Basis Points and helping us keep all of our content free.
Now, a reminder before we jump into it that all of our content here is accredited by the FAAA, and you'll be able to complete your CPD points by clicking the link in the show notes or description below and completing the quiz at the end of this episode.
All right, well, with that said, let's get to our conversation with Vern du Preez, investment specialist at Orbis Investments, about all things emerging markets.
Vern, welcome to Basis Points.
Thank you. Good to join you, lads. I think quite a few of my esteemed colleagues have joined you, some guys from London and from Bermuda.
Yes.
And now you're stuck with me.
Yeah.
No.
You're just as esteemed. Don't sell yourself short. We're here to talk emerging markets, and we want to, dig into the case for emerging markets generally, but then also really talk about what Orbis is seeing in emerging markets today. But let's start generally. Let's start with why it matters for advisors and for investors. Make the case for emerging markets having a role in a portfolio.
I suppose I could go hard with the product flog and say we've got this EM fund. I think it's pretty great, and you should invest in it. I might be a little bit biased. Doesn't mean I'm wrong, but I think in terms of making the investment case for emerging markets as an asset class or as a category, a straightforward way to put it is perhaps to say that emerging markets are a big part of the world. Lots of people, lots of businesses, lots of industries that many portfolios today barely touch. And perhaps to put some context and numbers around that, if you look at the definitions of the MSCI index, more than half the people in the world live in emerging markets, and they contribute north of a third of global GDP or global economic output. If you look at the numbers from the IMF or the World Bank, those proportions are even higher. So emerging markets are a not insignificant portion of the world. And if you exclude investing in emerging markets, you are risking missing out on a pretty big chunk of the global opportunity set by in terms of sort of sources of return, sources of genuine diversification.
When you say genuine diversification, how does that actually play out in a portfolio?
So diversification is obviously one of those things that's almost always mentioned in a investment conversation.
Yeah.
It's been said plenty of times in this room. Don't you worry. Yeah.
The old "don't put all your eggs in one basket" and all that sort of stuff. I think the issue is even if you spread your eggs across multiple different baskets and you end up storing them all in the same fridge, that could give you some problems down the line. Where today, many portfolios are very, very concentrated in a handful of areas, most notably the US, big mega cap tech and growth and those sort of things. And advisors by now know or should know that something like the Mag 7 makes up north of 20% of global indices. So our view is that with the market that we have today, a big risk is owning all the same things as everyone else at prices that don't discount or factor in that anything can possibly go wrong. We think that's a bit of a risk today, and you might want to be slightly prudent and maybe balance that out with something that has a low correlation to that. So if your whole portfolio or a big chunk of your portfolio is sort of dancing to Silicon Valley's tune, you might want to use something like emerging market to change the music a little bit.
Nice.
Well, let's make that tangible, because correlation can sometimes be an abstract idea expressed in ratios and numbers rather than sort of real life examples. So maybe can you give us an example of how an emerging market stock or sector zigged when developed markets, and particularly the US, zagged?
Correlations and things can get quite abstract when you look at things like efficient frontiers and all those sort of things. But I think at a basic level, the reason why you would introduce different investments with low correlations to each other is obviously to add a bit of a shock absorber to your portfolio. You don't want all your investments to move in the same way at the same time. If they all go up together, probably all going to go down together at the same time as well. That doesn't give you much in terms of protection. So if you look at correlations today and you compare, let's say, the US with developed markets, Australia and emerging markets out of that grouping, emerging markets has the lowest correlation to the US. So if you do a correlation map, emerging markets sit quite far away from those crowded areas. So EMs typically don't move in tandem with the US. But perhaps to make it a little bit more practical or tangible, you can think of it this way. If, for example, the US market falls because Apple has a bad day, or because there's some other wobble in Silicon Valley, a Hungarian pharma biotech company or a Korean online broker might crack on just fine because their fortunes isn't tied to what happens with Apple's iPhone sales, and it's more dependent on sort of local consumer spending and local activity.
That's the sort of broad general case for why emerging markets, but let's bring it to today because there is a more timely case, and that's a valuation one. Can you talk us through the gap that we're seeing when it comes to valuation of developed markets versus emerging markets?
Sure. Yeah. I mean, so as with all markets, emerging markets go through happy times and sad times. They go through these long periods where they cycle from optimism to pessimism, and they have been quite out of favor for several years now. They haven't been winning any popularity contests. They haven't been front of mind for many investors. So there's a fair amount of apathy about emerging markets, but that's often where the best opportunities arise. So currently, emerging markets are trading at around 13, 14 times earnings. that places them at a fairly big discount to developed markets, and roughly a 60% discount to the US, that's quite a big gap that you see there. It's about as wide as we've ever seen. The only other similar period would be during the Asian financial crisis of the late 1990s. So the last time things sort of looked like this, the iPhone hadn't even been invented yet. So the cycles can get pretty long. The difference though today is that there's nowhere near the same level of financial distress and broad-based economic crisis that was prevalent at that time. Yet this gap remains today, and that looks like a pretty attractive, compelling opportunity to us.
So at previous points in history, I guess that late 90s Asian financial crisis period, but also maybe at other periods where it's got close to this level of divergence between developed markets and emerging markets, what comes next? What does history tell us?
So this might come as a bit of a surprise to your listeners and advisors and investors, but emerging markets have actually outperformed developed markets since that inception of the EM index back in 1988. But they have disappointed, they have lagged over the past 15 years, as we mentioned. So there's a bit of a semi-persistent myth that emerging markets always underperform developed markets. And that's probably part of the reason why many investors have decided to simply move on to other things and forget about emerging markets a little bit. But to your point, historically, investors who stepped in at this point last time enjoyed a decade or more of outsized returns from that point. So when the sentiment shifts, emerging markets can re-rate and bounce back pretty sharply from those depressed levels, and it could very well be one of those points where investors look back on and they then wish they had acted once these happy times arrive again. So that's the case for emerging markets. Perhaps just to caution against something like the US, I think it's useful to remember that starting valuations is one of the best predictors of future returns. So at these levels and at similar levels in the past, with where US valuations are, the prospective returns over the next decade has been pretty low and close to zero or even less than zero on a real basis. So starting valuations and prices do matter.
So Vern, let's talk about the blind spot here for Australian investors. Many Aussie clients, they'll think that they've got EM coverage because they hold the MSCI World ETF or some global active fund. But why does that actually leave them, with actual, short when it comes to true EM exposure?
That's something you hear quite a lot, where people say, don't worry, I've got emerging markets covered because I own a global equity fund. But for a passive investor in something like the MSCI EM index, there's only about a 10% allocation to emerging markets. In the world index, only about a 10% allocation to emerging markets in the world index. So you don't get a lot if you go the passive route. And you might hope that your active manager is giving you greater exposure than that, especially given the opportunities that abound. But that's also not the case. So we looked at the top 10 actively managed, most commonly used funds in Australia by investors and advisors. And on average, you only get about a 6% EM exposure through those funds. So even less than with a passive approach. And if you look even closer at those top 10, only 2 of them are actually overweight emerging markets, where 5 of them have sort of zero or very close to zero exposure to emerging markets. So it's probably fair and accurate to say that emerging markets are deeply underrepresented in many portfolios, and it does present that potential blind spot.
So then some people will go a step further and they'll buy an emerging markets index. So we've spoken about on the show before around like where active and passive makes sense in different contexts. Give us a bit of the color on buying an EM index versus going with a active manager to get your EM exposure.
I think in emerging markets, you might want to be a little bit more discerning when choosing where to invest and what to invest in, because in EMs, passive investing can potentially be a little bit riskier than in developed markets. The indexes are cap weighted, as with most indices, so there's a handful of companies that dominate the indices. So in emerging markets, for example, state-owned enterprises are overrepresented in these indices, and that's often where governments don't care about shareholders all that much, so you might not want to be there.
Or they care about one shareholder in particular themselves.
Yes. So that's not really, maybe not where you want your clients' money to be invested. With a passive approach, you also get a fairly big chunk in Chinese equities, which has tricky politics and governance issues. There's a big chunk in Taiwan, obviously a tiny little island, fairly closely connected to China. You also get a big allocation to India through a passive approach, which is the most expensive emerging market in the world at the moment, almost on par with the US. And then you also get a big chunk in banks, which are often highly leveraged to local economies. So that's of what if you end up investing $100 in an index, that's the default split that you get. And you might just want to ask yourself the question, how comfortable am I with that default allocations I'm getting in emerging markets, given the emerging market specific risks and concerns?
Well, perhaps if you could provide an example of a company or companies that you're currently avoiding that do sit in the sort of passive market cap weighted indexes.
Yeah. So for the EM index, the front row is essentially chips, clicks, and rupees. So you get Asian tech hardware, you get Chinese internet, and you get Indian financials. But there are a handful of companies at the top of the index that we don't own. Things like Alibaba or Xiaomi. I'm never sure if I pronounced that correctly.
Xiaomi, yeah, whatever.
Xiaomi.
That one.
Yeah.
Both Chinese listed companies that we don't hold, and they are pretty big members of the index. But our biggest underweight is India. We hardly hold anything in India, essentially zero.
Wow.
And then you compare that to the index weight of about 16%. So it's a fairly big diversion from the index benchmark and from other managers out there. We just find India quite expensive on a variety of valuation metrics. So it's probably not unsurprising that a manager like us is struggling to find many attractive opportunities there. There will be, and there are companies in India that we would certainly love to own, but it has to be at a price that makes sense.
Yeah.
Nice.
So I imagine when you're going around speaking to advisors and also institutional clients, you hear a lot of misconceptions around emerging markets investing. Give us some that make you tear your hair out. Now, obviously, you and I have that ship has sailed for us. But what's some of the ones that really frustrate you that they continue to persist?
I think it's those knee-jerk reactions where many people think that emerging markets equals chaos. But if you look at countries like Taiwan and Korea, for example, they've got better broadband speeds and better infrastructure than most developed countries out there. Another very common misconception is also that fast-growing countries equals fast-growing stocks. The data doesn't back that up. In fact, there's only a very loose relationship between GDP growth and stock market returns.
That's really interesting. I would have assumed that as well.
And it seems intuitive. But for example, if you look at markets like Brazil, Chile, and Mexico, they've delivered much higher returns than India and China, for example, over the long term, despite having lower GDP growth. I'm from an emerging market myself in South Africa. GDP growth in South Africa hasn't been terrific for a long time, but the stock market has done fairly well. So there's really no direct link there, which is sort of counterintuitive. So that focus then on chasing GDP growth in a place like India might be a bit misplaced. And another another common misconception or view is that emerging markets are too wild, they're too volatile. But if you look at the numbers again, emerging market volatility has actually come down over time and it's converged with the developed world. So it's much more attractive for risk-conscious investors these days. And people also think that emerging markets will do worse during the tough times. It sounds sort of intuitive, but again, the data doesn't back that up. In fact, since the year 2000, emerging markets have actually outperformed in 2 out of 4 major US bear markets. And you might be sort of surprised or interested to learn that even during the most recent Liberation Day sell-off we had in April, emerging markets did better than developed markets. So they can hold up reasonably well during times of global stress.
Well, Vern, we're going to take a quick break, and on the other side, we're going to turn to finding winners in emerging markets and how we can manage risk. We'll be right back.
Thank you to Orbis for sponsoring this episode of Basis Points.
Orbis has been investing in undervalued and ignored global stocks for over 30 years. They're interested in long-term potential rather than short-term performance, and their international team of 60-plus investment professionals concentrate on unearthing companies trading for less than they are worth rather than timing market trends.
Orbis has applied the same fundamental, long-term and contrarian investment approach since its inception and has over 60 billion Australian dollars in assets under management. With the investment landscape rapidly changing and with valuations where they are today, Orbis's contrarian style and high value exposure can make it an effective diversifier in client portfolios.
Welcome back to Basis Points. We are here with Vern from Orbis talking all things emerging markets. Now, we've just spoken about the blind spot and why people are underweight here in Australia, Vern. So let's talk about how we can actually find winners in the emerging market space. When you guys are actively looking for winners, what are some of the characteristics that you're looking for?
It's not an easy job. Ideally, we're looking for good, durable businesses with leaders who care about shareholders, and all of that at a good price. So that would be the holy trinity of what we're looking for. Easier said than done, though. But we start looking for, and we ideally look for businesses that are overlooked or misunderstood by the broader investment community, and that obviously grants us that opportunity to buy them at an attractive price. In emerging markets specifically, we've got a big preference for family-owned or owner-operators with skin in the game, and then combined with that, little or no debt and long-term prospects.
So can you share an example in the portfolio currently that ticks those boxes?
The one good example that comes to mind is a company called Jardine Matheson.
Oh, yeah.
They're a Hong Kong-based conglomerate, one of Asia's oldest and most respected businesses. They're nearly 200 years old. Quite a colourful history, and they are, to this day, controlled and managed by the founding Keswick family. I think now in its 5th generation. And they've got this reputation of not thinking in years, but thinking in decades. So Jardines, in terms of what they do for a business, they are an investment holding company, and they own a collection of high quality businesses across Asia. Many of them leaders in their own field. But despite the strength of Jardines and the underlying businesses, they have been caught up in this general apathy and pessimism towards emerging markets. So the market currently values Jardines at a quite sizable discount, around sort of 30% to the sum of its underlying parts. And those underlying parts are themselves trading below intrinsic value because they're subject to the same pessimism and apathy in emerging markets. So that gap between what you pay for Jardines and what you actually get is fairly sizable. So that's quite attractive in our book. As always, there's uncertainty. You never know how things are going to play out. But this low valuation, we think, is overly pessimistic. It reflects overly pessimistic expectations. So it should bode well for future returns.
Now, Orbis has a reputation for contrarian investing. Are there any names in the portfolios that you find yourself sort of having a very different view to, in the industry consensus?
Quite a few of the holdings in our top 10, actually. If you look at holdings like Kiwoom Securities, Jardine Matheson that we just mentioned, another company, Wise, these are all
What's market getting? What is the market saying about Wise that you guys think otherwise?
Isn't Wise UK listed?
So here's the thing. That's exactly. So they are all. So Kiwoom and Jardines are tiny constituents of the index, but they're fairly big positions in our fund. And Wise is an interesting example because it's not even in the EM index at all. So it's probably not on the radar of many emerging market investors. So Wise is listed in London, but it's an Estonian-based fintech company.
Oh, it's Estonian.
So if you're just filtering based on things in the EM index, Wise is not going to screen up.
Yeah.
But just because they happen to be listed in London, they're still a EM company. They've got their head office in Estonia, and so it's quite an interesting example.
It's good to sneak that in the portfolio.
Yeah.
And it's great business. I mean, they along with those attributes we look for in companies, they were established in 2011 by two Estonian friends and entrepreneurs, and they've set up this sort of global payments network and infrastructure across more than 170 countries, I think more than 40 currencies. So they're quite a major player in these cross-border financial transactions. One of the co-founders still leads the business as CEO, and he's also the major shareholder. So there's that skin in the game that we like. We're backing the entrepreneur. We like they've got skin in the game, and they'll be moving their primary listing from London to New York. So that has been sort of passed with shareholders, and that US primary listing is likely to support the re-rating of Wise's share price, given that like typical higher valuations put on high-quality fintech companies in the US. But it's probably not in many EM portfolios.
Might just note that down.
Yeah, I mean, this is a completely unrelated point, but Wise moving their primary listing, AstraZeneca moving their primary listing. What is happening in the UK at the moment? Yeah. Obviously not an emerging market, so I'm not asking you to answer that, but they got to get their mojo back. All right, let's get back to emerging markets and let's talk about the other side of the coin, because we've spoken a lot about the opportunity in emerging markets, but there is risks that you need to manage when you're managing an emerging markets portfolio. So you often hear about, regulatory risk and currency risk. First of all, how do you think about these risks when they're raised, and then how do you manage it across a portfolio?
Yeah. I mean, one can say the same things about the US these days, about the government shutting down and things like that, but let's leave that aside.
Yeah, I mean, if you want to tee off, go for it. We'll just sit here.
That's a whole nother podcast. You can argue that governance can potentially be a bigger issue in emerging markets than in developed markets. And that's often because the rules and protections for shareholders aren't as strong in many EM countries as elsewhere, which could mean that weak management teams stay around for too long. Money isn't necessarily spent wisely, and it's sometimes quite tricky to figure out who actually controls a business. So we are highly focused on those things during our due diligence process when picking stocks. We invest meaningful stakes in businesses, so that allows us to engage constructively with management to improve things. That allows us to form long-term relationships with companies. The average holding periods for a big part of our portfolio is north of 5 years, some even longer, 5, 6, 7, 8, 9, 10 years. So we do form these long-term relationships and engage with management quite actively. But the way we manage that is really by focusing on owning resilient businesses with good governance and aligned management. So we just apply a fairly high bar for a stock to make it into our portfolio. We only hold 35 stocks in the portfolio, so it's fairly concentrated, and we are pretty close to most of these businesses and can move swiftly when we need to.
Yeah, nice. And so then, are there any, sectors or countries that you're looking at the moment that just have too many risks, or that that you just think the environment's not right?
So no sector or country gets screened out or excluded by default.
Okay.
For any investment,
not even like Argentina at the moment. You wouldn't just say even if there's cracking companies there, the economic situation is just.
So the way our team approaches that is if they would typically, for a specific company in a specific industry, perhaps demand a 30% discount. If it's an environment like that, they might say, okay, I'll be happy to go there if it's a 40 or 50% discount.
Yeah, right. Okay. Yep.
So if the discount is big enough, we're happy to have a look.
Who's demanding the biggest discount?
Yeah.
I think the interesting thing is also in emerging markets. If you compare that to developed markets, it might be a different story. But because they're all part of the same group of emerging markets, there might be markets that you wouldn't invest in, let's say, a global equity fund, but you might invest in emerging markets fund, because that's sort of the game you're playing. That's the space and the rules that you're playing in. So the discounts are almost like baked in a little bit already, because you are looking at emerging markets. There's nothing that we are categorically avoiding at the moment.
Okay.
I mean, back to India, that's the biggest example of what we are essentially avoiding.
But that's because
that's
valuation.
the other way.
Yeah. So everyone, it's not sort of
it's not a dog's breakfast.
Governance risk or regulatory risk or the country's going to collapse risks. It's just valuation, where everyone seems to be bullish on on India. The growth story can very well be real, but the valuations are just too sky high. So we are very much underweight the consensus there, where everybody else is overweight.
Yeah, the time to invest in India was 3 years ago or something, unfortunately.
I mean, other large underweights include China. It's still a bit too hairy for us, too many state-owned enterprises. We're also underweight Taiwan, even though we own TSMC, which is a big company. And on a sector level, our largest underweights are IT and materials and energy, because in EMs these are often sort of just government-run polluters. And a fun fact, in many EM energy companies, not to drag South Africa into this, but in some of them, governments own more than 70% of the equity in these companies. And again, that's not really where shareholders would probably come last in that setup, and that's not where you want to be investing your clients' money. On the flip side, we are overweight areas like Korea. It's sort of cheap, it's unloved, and governance reforms are starting. So we would much rather prefer to be early with a comeback story than late to a victory parade.
Nice. Well, Vern, as we close out, if any advisors listening if this conversation has got them to sort of rethink their clients' EM exposure, or how they're getting that exposure, maybe thinking about active over passive, what practical steps would you suggest that an advisor can take, both in terms of how they can think about reconstructing portfolios, but also having those conversations with clients?
So first, have a look under the bonnet. Have a look at how much EM exposure you actually have. Odds are it's not much. So people sort of inadvertently don't get the EM exposure that they think they might have, even if it's an accident. Secondly, think hard about diversification. Emerging markets offer you exposure to different engines of growth, and pretty good bang for buck if you want to diversify away from those crowded, expensive areas. And then lastly, valuations. We talked about price. The US is trading at perfection. Emerging markets are trading sort of for pessimism, and pessimism can often be one of the cheapest assets you can buy. So the client conversation can go something like, if you want genuine diversification and exposure to parts of the world that are unloved and under-owned, emerging markets deserve a seat at the table.
Love it. Well, Vern, thank you so much. I'm sure plenty of advisors and clients listening today took a lot out of that. So we appreciate you coming and sharing your time with us.
Thank you.